Thanks for calling in. How can I help you?
So my question, the original one was, are there any environmentally friendly funds you would recommend? Because I would like to transfer my money from what I have into some of those funds, but I don't want to fund the things that I don't want to support the causes that I'm not in favor of.
That's a great question, and it's becoming a frequent question these days because many investors, especially millennials and Gen Z, are becoming increasingly aware that there are a lot of scummy companies on this planet. Now, one thing to bear in mind about this is that there is no perfect fund, unless you want a stock pick, but then it's very hard to get a diversified portfolio because you're going to want to have hundreds of different companies. That's very time consuming. So for most investors, there are going to be some compromises that are involved. For people who are unaware about how to invest ethically, we're talking about ESG funds. These are funds that are trying to exclude the worst actors. But no fund is exactly the same. Each fund company has to take kind of a shot in the dark at what are the worst companies, the absolute worst transgressors in the business world, and kick them out so that they can appeal to the most investors. Now, the number one target of a lot of these funds is the oil and gas industry. They have been kicked to the curb. This actually worked out really well for ethical investors in the past. They actually outperformed the market because they ended up being tech heavy. But that also meant more exposure to Apple, Microsoft, Google, and Facebook, which you may or may not like. So the first thing is, before we start going into the funds themselves, to bear in mind is that if you're trying to invest with ethics, look at the funds, look at what they invest in, look at what they're trying to exclude. Spend a little bit of extra time here because you might see two ESG funds. They both say, hey, we like the environment, but one might have Exxon in it, and they might exclude Chevron, for example. The other one might not have any oil at all. So there's a real opportunity for you to really fine tune your ethics here, but you have to be careful. Just seeing a fund that says they're ESG isn't enough. Now, you said you want to transfer in, and we're going to get to specific funds in a second, or at least fund families. You are aware that when you sell in a non-retirement account, there might be some tax liability. So make sure
This is a retirement account. It's a 401k that I only have about $3,000 in.
Perfect. Okay, I appreciate you mentioning that. 401k, $3,000. Well, that makes it easy. You're moving money within a retirement account. You're probably not going to run into any taxes and any fees. Most of the time when you trade within a 401k, there isn't going to be a cost there. Now,
I think it's like a nominal, like a few cents per trade type thing. Very, very small.
Perfect. That's a wonderful thing. Now, does your 401k limit your fund choices? That's very common.
Or does not that I can tell. I mean, I try to research stuff on there. I'm using Ameritrade, and it's just very difficult to navigate and find specific funds. But I haven't seen any limits other than the really low, like junk, penny funds or whatever that's below $1 or below 50 cents. It won't let you trade on those.
Okay, it sounds like Ameritrade then is extraordinarily flexible. A lot of the times when you have a 401k, 403b, or another type of retirement plan, they limit your fund choices, which is actually extraordinarily detrimental these days because so many cheap, great investment options are available across the market that having a limited fund list actually limits people to worse funds than are available. But it sounds like you might have flexibility here. That's a wonderful thing. You're going to be able to get a low-cost fund. Now, when it comes to ESG, you have to know something. The finance industry loves it because they can charge you more when it comes to the expense ratio. This is what you're going to be paying yearly. The expense ratio will be higher. They can charge you more without giving you higher returns. This is why the finance industry is obsessed with ESG, because the more people they can convince to invest ethically, the more money they're going to make. So you got to be careful of the ESG funds that are out there. Now, two fund families that are on the cutting edge of low-cost, well-diversified ESG is iShares and Vanguard. iShares is the ETF lineup for BlackRock. These are the two largest financial investing firms on the planet. We're looking at BlackRock, we're looking at Vanguard. I would start by looking into their funds. Try to keep the expense ratio low. It's going to be harder this time around. The cheapest I'm aware of is Vanguard's ETF lineup, but I don't know your ethics. You're going to have to look at what they exclude, what they keep in, and see if it's a good compromise. And you will have to compromise on the ethics, but I would strongly encourage you not to compromise on the expense ratio. Try to make sure, whether it's an ETF or a mutual fund, keep it under 0.2%. Additionally, try to stay with indexing. There's a lot of active ESG funds, which really brings together the worst of ethics and active funds, which is you don't know which companies you're investing in because they're trading in and out while simultaneously having all the issues of high fee active trades. Not great. So I would, if I were you, start your search with the top 2 ETF providers, assuming your 401k can hold an ETF. Look at BlackRock, look at Vanguard, see what they offer, and check that expense ratio, in addition to obviously what the fund is investing in. For the record, for people in general who are listening to this, my general rule when it comes to what low cost means, when it comes to investing in general, keep it under 20 basis points. You want it less than 0.2% when it comes to the expense ratio. When it comes to ESG investing, if you go a little bit above 0.2%, fine. But you do not want to be touching 30 basis points or higher. You shouldn't have to do that in this day and age. There are plenty of great low-cost ESG funds, and do not accidentally sacrifice your financial stability long-term in return for trying to be ethical in the short term. You can do a lot more good long-term, making money and then contributing to causes and charities you like, than you can by trying to hinder your financial progress by being entirely ethical the whole way through. All right.
Awesome.
Excellent, Matt. Any follow-up questions to that, or did you want to get to your second question?
No, I think I got notes here. I think what you told me. I mean, I may have questions again another time after I do all this research and come up with stuff, but we'll limit that if that's the case. My second question would be about the best time to buy stocks. I've been noticing like everyone seems to get their paychecks and their 401k disbursements on the same beginning of the month and the middle of the month, and it seems like that has an effect where the market seems to shoot up and then it kind of goes down. So I'm wondering if, based on how people's funds are distributed, there's a certain day or time of the week or whatever you would recommend actually purchasing funds.
So the good news is there is mathematically a best time to invest. And the answer is, historically, when they run all of the numbers, the best time to invest is as soon as possible. This makes a lot of sense when you think about it. There are more up days than down days when it comes to the market. The good times outweigh the bad, or else none of us would invest because the stock market would be at zero. So the game really is, every day has a higher chance of being good than bad. So how do you win? You play as often as possible. You get your money in the market as fast as possible. There are people who
only get my money on certain days. And it feels like those days I get it, the market's higher, and then I buy stuff, and then 2 days later, everyone's not buying anymore, and it's always back down.
I promise you, historically, when you look at the data, that's just feeling. As soon as you get paid, dump it in, unless you have other uses for it, like paying off debt, emergency fund. But if you're looking at it from just an investing angle, the faster you get it in, statistically speaking, the more money you will make long term. In the short term, you might dump it in tomorrow, worst day ever. Another 2008 happens. This time it's the tech industry. Apple's bankrupt, Tesla's bankrupt. Who knows? But mathematically speaking, when we look at the past, the sooner you get it in the market, the more money you typically make long term.